Welcome to Turtle Talk. Dive into the fascinating world of timeless trend-following strategies and the pursuit of the elusive outliers made legendary by the turtle traders. Join your hosts, Adam and Rich, alongside our esteemed co-host, Jerry Parker, as we uncover the powerful principles of classic trend following. From counterintuitive practices to the mechanics behind capturing market outliers, each episode offers a masterclass in navigating the financial markets. Expect in-depth discussions, expert insights, and actionable advice to help you master the art and science of diversified systematic trend following, turtle style. Tune in every month as we explore the dynamic and ever-evolving world of trend following, equipping traders and enthusiasts with the tools to succeed. And now, without further ado, let's hand it over to your hosts, Adam, Rich, and Jerry.
Welcome back, everyone, to Turtle Talk, Episode 8. It's Thursday, the 30th of October, 2025, and I'm Rich Brennan coming to you from sunny Brisbane. With me, as always, is my fellow Aussie Turtle, Adam Havryliv, calling in from beautiful Scotland Island in Sydney, and of course, the original turtle himself, Jerry Parker, joining us all the way from Tampa, Florida. Adam, did you get those storms that rolled through earlier this week? They knocked me out for nearly 30 hours here in Brisbane. No power, no internet, total blackout.
You got the worst of it. So we had something on a much smaller scale, but didn't lose power, and we were able to keep commuting across the water here. So, how was your power situation?
Mine went down for 30 hours. So the fridge turned warm. My addiction to social media was quelled because I couldn't respond to any posts I was seeing. I had my phone, of course, but I hate using that phone when I'm responding to social media. But it kept me at bay and it kept me in the dark.
Well, glad to see that you're back online.
Exactly. And Jerry, how's Tampa treating you? Did you get any hurricane chatter over there, or is there finally eased off?
It's almost over. Knock on wood, we had nothing. And I know the weather forecasters are very disappointed, but we went from two devastating hurricanes last year to zero this year. And the weather's still pretty nice. We're into almost November and we're still in the 70s and 80s. So that's why we moved to Florida.
That's great.
Sounds amazing.
Wherever we are, there's always something brewing, whether it's storms or whether it's financial markets. So we've got a packed show today, no guests, just the three of us, and here's what's coming. First off, we'll be talking Battle of the Trends, where we'll unpack September's standout month for trend followers of all shapes and sizes. Then we get into our segment, What's Moved the Needle, where we take a deep dive into the current price action and discuss the movers and shakers through some chart analysis. Then we get into MythBusters, and this is where Jerry's going to be taking us onto a romp into the world of pyramiding trades into trend. And then our spotlight feature this month, it's a special one. This is where Jerry's going to flip the script and interview us, Adam and me, about our new book, The Aussie Turtles Trend Following Guide, which Adam and I have just released on Amazon. So then we'll finish off with Shell Mail and your listener questions from around the world. We've got some great questions this week lined up from our friends in the Trend Following tribe. So without further ado, Adam, let's kick the ball and get it rolling, and let's dive into Battle of the Trends.
Well, September, it feels like an eternity ago, given what's been going on in markets this month, but another strong month, a really, really, really strong month for all of the trend following indices. So we're talking, threes, fours, fives, almost 6% for the various indices. The standouts were TTU, Trend Following Index, followed by the SG Trend Index, and followed closely by our own classic trend index at 4.9%. So that gives you an idea of what's been going on in trend following for September. And we're looking at some really fantastic, quarter numbers Classic Trend Index up almost 10% for the quarter. And, I think we nailed the low in this trend following correction a couple of months ago, when we said that's probably it. That's the low, and I suspect that we will be at or near all-time highs for Classic Trend Index and probably these other programs as well. If not this month, then surely by the end of the year, assuming that trends continue. So no guarantees there, but based on past performance, that would be an entirely expected result. September performance, I think, influenced by continuation of trends in metals and equities, and a bit of a reversal, in bonds, which may have dragged on some performance, but across the board, those trends look strong. Rich, do you have anything to add?
What stood out to me was how broadly that strength carried across all of the trend following community. So, short-term programs, long-term programs, they all fired at once. And you don't get these months very often, but when you do, it's a reminder to me of why trend followers build robust frameworks instead of chasing forecasts. So we don't care why trends expand. We just react when they do. And that's what I believe is the power of process over prediction. But it's in times like this, these are the times I call trend following heaven. The first 6 months of the year certainly wasn't that, but now we're in it. But it's times like this, in these good times, where we can look back at those difficult drawdown periods and realize something very important, at least to me. And that is, if we had tinkered or adjusted or second-guessed those models during that pain we had in that first 6 months, we wouldn't be sitting here now enjoying the payoff today. And it's those moments, they're the validation of patience to me, the proof that it's enduring the discomfort is what earns you the right to participate in times like this. That's how I see it.
Yeah, and I don't think we got to trend following is dead levels of desperation, but April was a shocker, no doubt, and it came on the back of a couple of months of weak performance for the strategy, and so the articles were out there, worst performance in 20 years and all that sort of stuff. So it got pretty bearish on the strategy, and good luck to those people that have made an allocation during this drawdown. Very astute. Hopefully we can close out a great year. I think we're back in the black probably for Classic Trend Index for calendar year 2025, which means that we will have, 6 years coming up to the 6th year for tracking this index. Obviously, Jerry's strategy goes back a lot longer than that. And hopefully we can close 2025 in the black, which means that the Classic Trend Index would have only been down 2% in 2023 after posting, double-digit gains in all of the other years. So if you're looking at it on a calendar year basis, I'm just looking at the stats right now. We're posting 17%, 32%, 23%, and 20%. And the only red year was 2023 with a down 2%. Now, what's not to love?
Yeah. JP, your thoughts?
Yeah, I would like to congratulate both of those people who invested near the lows. That was really good of those two people who did that. I was just thinking this past week, I need to be the most bullish at the lows, bullish on trend following and the strategy. And here you have someone who's been doing it for 40 years. And I wouldn't say that I was extremely confident or bullish. I was just trying to ignore the bad performance and the bad days and months, and just in the background, my traders and my computer people are producing the trades and doing the trades, and I'm just trying to ignore all of the actually what's going on. But I think embracing that and getting out there and maybe marketing during times where, and talking to potential clients to say, hey, now's really the time to buy. Don't have the stomach for that, and I think but that's the attitude that you need to have. So it's never going to be a problem to have confidence and do the trades and not tinker with the systems too much. That's what I feel like now. Like the next time this happens, I'll be extremely confident that it's, the trend following is still great and not dead. It's always the next time.
It's always the next time. All right, gents. So shall we move on to what's moved the needle? Here is where we look at the markets shaping momentum right now. So, Jerry, you've been tracking a few very interesting charts. What's caught your attention?
Well, I'm not really following the rules on this segment here. And so these are just two stocks that I'm short that I sent to you guys. And they're not really driving my portfolio because I trade 400 markets, so nothing is really driving it too much. And I just wanted to present these two examples of these great downtrends in these two different stocks that we trade that are occurring during a period where stocks are going up. And so that's why I think it's so important for us to trade these single stocks and have some longs and have some shorts and take advantage of the diversification that you can get outside of indices. I'd say right now about of the 200 and a little over 200 stocks we have in the portfolio, 60% are long and 30% are short. So probably to a lot of people that sounds incredible. Like, how could you be 30% short from a trend following, long-term trend following point of view when the S&P keeps hitting new highs? And it just shows that there are downtrends when the market is going up, and probably there can be some long uptrends when the markets indices are going down. Are you able to put those charts up? Yeah. So one is Fiserv, and it's had a big move today. It's been in a downtrend for a while, and it had a big downtrend today, down 43%, kind of crazy. And the other one is Verisk Analytics, and it was down 30% today, but it has been trending down a bit as well. I think that the chances of getting these sort of these trends against the indexes are probably more probable in the stocks than I would say certainly in the currencies or the interest rates. The stocks are going to have a tendency to be more different than those two other sectors where we're pretty much at the same position and we're in the same direction in almost all those markets. And another great thing about these short stock trades is we build these positions over time. We're building them all the time, and we're creating them over time. So we're not getting short all of these. We're not getting short all of these different stocks at the same time, like we would be, like we'd have a tendency to do with an index where they were pretty much all going up in April, and then before April, then they sort of all collapse at the same time, and so you get a bit better diversification with these individual stocks. And granted that the stocks, all the stocks can have a big sell-off at the same time. The proverbial stocks can go to 1. They have, and they will again. For me, the key is to increase the odds of having some shorts on. And the single stocks are better than the indices in this regard. They're much better. They're better on the long side, but they can even help a little bit on the short side, because during April we came in and we were probably 20% short when the all hell broke loose and due to the tariffs. And so It's one of the reasons I'm a big fan of following the trends, long and short, on the individual equities.
That's great, Jerry. And the way I look at it is that by being both long and short, like most people, if they're applying relative momentum or different methods, they wouldn't be experiencing these short opportunities that you are with this absolute trend following that we do, this absolute momentum. But what I think it does as well is by having exposure to both longs and shorts, it increases our diversity and reduces our brittleness. In other words, I think in this trending environment, the S&P 500, the Russell, all of the equities, they're all bullish. Everyone is prone now to be directing their efforts towards the long bias. And I think that commonality of logic basically makes these markets brittle over time. They're less diverse, less robust, less strong. So by having exposure to both long and shorts, you're covering your basis in a more robust framework. This is how I see it. And that's why I think it's so essential to be both long and short. And I love the opportunities you're seeing here. They're great breakouts to the downside with these two in a world where everything seems to just be going up.
Yeah, historically, the shorts stocks, shorts in general, haven't really done very much, haven't made a lot of money. They have a tendency to help out with diversification sometimes, especially when the longs are not doing so well. But it could be like a cocoa thing where not trading something like a short stock or keeping cocoa out of your portfolio, it puts yourself in a situation where things can change, and all of a sudden we get one of the greatest moves of all time, or all of a sudden we go through a period for multiple years possibly where shorts and stocks and shorts and all the other markets do a lot better than they've ever done in the past. And I think that's one of the keys to allow trend following to profit over things that we've never really seen happen before or happen very much. Rich would tell us back in the day, it's good to trade something that helps your long-term trend following systems, but maybe hasn't really made money, but it's diversified enough to help out when your better systems are not doing well. So I think this is my commitment and sacrifice to trading short on the short side, even though historically it hasn't done very well, but and it's probably going to be kind of a net loser over time, but during some periods it may help quite a bit.
Yeah, that's really interesting. I'm just looking here at the correlation between classic trend index and the S&P 500. It's 0.11. So, you could call that uncorrelated. And that diversification that Jerry's talking about is effectively what's delivering that. And I know I pinged you on 10 October. S&P 500 was down a lot, and I'm like, oh, I wonder how Jerry's going, because you have a daily mark to market with the ETF. We do monthly numbers, so we don't really have to get into daily reporting or attribution in that sense. And your ETF pleasantly was green on the day, and I thought, wow. You've certainly must have a lot of diversification in there, and those shorts would have been working overtime. So, congrats, Jerry.
Yeah, most of the time I'm really not happy that I'm not more correlated with the S&P, because it's hard to beat in those 7 stocks. We have 210 single stocks, and even if we had all 7 of the Magnificent 7, it wouldn't move the dial very much. But sort of even taking the stocks and putting trend and trading them with trend following and doing shorts, we're still sort of using the same trend following approach with the money management and the stop losses and the trailing stop. So it has a tendency to not perform as well sometimes as the stocks, especially when you have the big sell-offs and the V bottoms and they rally back to the highs. So you can get quite a bit of a difference performance with trend following individual stocks, especially if you, like you would in your typical managed futures portfolio, you're trying to find all this diversification, different markets, alternative markets, sunflower seeds, white maize, iron ore, everything under the sun. And you're really searching for that. Well, that's what I do with the stocks. I'm searching for this massive amount of diversification where on those type of days when the S&P does really well, I might not do as well. And if it does really poorly, hopefully I don't do as poorly.
That makes a lot of sense, Jerry. When I look at those two charts you put up, I see the asymmetry in it. So what I see is I see this trend slowly, progressively getting higher and higher and higher and higher. And then when the turn occurs, it's typically much faster descent than the rise that preceded it. And that's what I'm referring to as a fast unwind from a tightly coiled spring. So the way I see these trends following is they emerge out of a period of compression or apparent stability. They emerge with an explosion of volatility. They then extend directionally. And as they extend directionally, more and more traders start jumping on board the directional trend. And this reduces diversity because everyone's going up. They're not going short, they're going up. And so over the course of time, the trend becomes more fragile because we get this reduced diversity as the trend extends until we get to this tipping point, and then we get a massive unwind of that structure, which is inevitably a cascade or an avalanche, not a progressive build like you get with these trends. So that's why I see that asymmetry, and that's how I justify why trends ultimately end is when too many people are doing the same thing. It reduces the robustness in the market itself. It becomes very fragile, precipitous on a knife edge because everyone's doing the same thing, the lack of diversity here. But what you're saying is that this is why you counteract that with models that are both long and short. You're looking for diversity of expression. You're removing that fragility by your diversification and process. And this isn't something we can measure through statistics. It isn't something we can we just know. This is experience talking in how you make things more robust and able to deal with situations that change on a pin and you can't predict.
Some of the CTAs, and there's a big move in the managed futures space to combine your trend following program with long indices, long S&P or long stock indices. And so 50% trend following, 50% long stocks, or 100% in the stacking idea. You take 100% index long and combine that with 100% of the trend following program. And you can just see how that's so much different than saying, hey, trend following is the greatest thing on the planet. You can't beat it. It's great. Buying and holding stocks, I hate that. I don't want to do it. It's crazy. I don't want an 8% return and a 50% drawdown. So I'm going to trend follow these stocks, and their performance is going to be so much different. It sounds similar, but it's not going to be the same. As an industry and as a group, how much do we love what we do? How much do we really believe in trend following? You're talking about during drawdowns. Well, how about now? Are you going to trade those stocks with trend following, or are you going to stack them? Or are you going to add them on to your, and have a dual product of managed futures and stocks, or are you going to say, heck no, trend following is worthy. Trend following is better. That's what I'm saying. So it's different, and it's over time, it's going to be better. Right now, not better. You can't beat the Max 7. You can't beat what's going on in the S&P with the trend following. It keeps going up and making all-time highs. But I think that's another thing that the industry and CTAs in general are not ready for. They're not ready. They're not saying to themselves, are we ready for the time where trend following gets back to the way it was 15, 20 years ago, when it not only made more money than stocks, but of course the risk was a lot lower as well. I'm ready. I don't know if it's ever going to happen before I leave this industry, but I'm ready and hoping it will happen.
Yeah, well, if you put up the S&P 500 chart there, we're obviously breaking out to new highs, all-time highs over the last couple of days, and we had a really interesting gap on the Monday morning. We have not filled that gap. and I'm not saying that we have to, but it does look super bullish, the S&P 500 at the moment. But then if you look at it on the 1-year chart, and we've got the 200-day moving average there. I mean, this has actually been quite hard to trade because we had a correction. It was 20% or whatever it was, and that may have triggered, certainly would have triggered exits from longs and perhaps short trades. And then we've had a very quick reversal, and then now we're getting an explosion higher. So it's not to say actually that just being passive long equities has been easy, and certainly trend following on this market I wouldn't call that easy either, but you just got to take those trades. So I guess here when we broke out above, I think it's around about 6,200, that was obviously the time that a lot of these systems would have been piling back in had they not bought on a close or something above the 200-day moving average, and it's been pretty one-way action since then, and I guess we'll just see how that works out for everybody. But the other part of the market that has obviously been keeping everybody focused is the metals, and the big one, gold, up to 4,400, and then a pretty big correction. So that may have shaken out some trend following systems. It depends on how loose your pants are. Jerry's probably just sitting there going,
well, he's got the loosest pants of us all.
He's got the loosest pants, yeah.
I didn't even notice gold. I haven't noticed gold yet.
Wow. See, that is classic trend following. Hasn't noticed. It doesn't even show up on my radar. People are panicking, jumping off buildings, $400 correction. It's not even coming up on Jerry's watch list. So same with silver, that's been a pretty big one, and platinum, a pretty big red day there with that really interesting candle, that big red candle.
I have no idea what a candle is, and if you try to tell me, I'm going to take out my headphones.
Well, it's what I did when I was in blackout this week, Jerry.
Yeah, exactly.
The power was down.
I want to leave.
I put this month's charts with candles because I like. We're coming up to Christmas. I like a bit of red and green, but I keep my moving average in green. So that's been a pretty interesting market. Obviously, trend followers have made a lot of money in metals in the last year, and also especially in the last quarter or a couple of months. And so everybody would have given back a little bit here. It'll be interesting to see.
Those three metal markets were very correlated, mate.
There's probably a lot of dynamic position sizing going on that's causing some of these sell-offs. Oops, sorry about that.
You don't think it's our own industry contributing to the downward volatility?
What's funny is that they are indiscriminately selling when they get those signals and reducing risk, but causing more risk.
Yes.
Right. So
it's a mess. So
the vol adjusters would be looking at this, saying the daily ranges are increasing. Let's just say they've doubled, right? And so our risk has effectively doubled on this trade because the daily range is 2 times what it was when we put the trade on. So we better sell half this position in order to get our risk down to some optimal, quote unquote, optimal level. Is that the philosophy these people are adopting?
They say a lot of things. One is we don't want this one market that we have a portfolio of 100 markets. Let's say we have this one market that it's properly sized 1 out of 100 when we put it on. Now it's dominating the performance each day. We don't want that to occur. We can just pull up silver and gold, and that's going to determine whether we make money or not. That's not good money management. That's not really good risk control. Clients don't like it. We don't like it, so we're going to do that. And we're like, no, we're outlier hunting. You're going to do better, make more money in a risk-adjusted way by letting that open trade profit that it's going to be difficult for that market to turn into a losing trade. It's going to be, we're going to let that thing run because we may see 5,000, 6,000 in gold. And they'll say, oh, yeah, we'll see 5,000, 6,000 too, but maybe we'll have on 1/10 of our position. We don't know. So you say a lot of things.
Yeah, and then if you go back to the indices that we look at Battle of the trend following indices or indexes, I'm not sure how we pronounce that on the website. Battle of
Indices.
the trend following indexes.
Indices.
Oh boy.
You say potato, I say potato.
Exactly.
So, this is why classic trend index is like up here, and then all these other indices are clustered at a much lower CAGR. And the funny thing is, you're not getting better risk-adjusted returns for the lower CAGR. So actually, the classic trend index not only outperforms those other indices on an absolute basis, right? So CAGR, compound annual growth rate over the period of analysis. Ours is something like 15% versus, line ball, I'm saying the others are doing at 6 or 7%. But risk-adjusted returns are better as well, right? So the MAR, 0.92, the next best MAR is 0.59, right? So 50% superior MAR ratio to that other index. I'm not going to get into the individual indexes, right? And then Sharpe ratio. Okay, so we know it has limitations, but our Sharpe ratio is 0.86 on that index, and the nearest competitor I see has a Sharpe of 0.42.
I think
100% difference.
Anyone on this podcast who mentions the word sharp, I think should be banned or sent to the sin bin for about 2 minutes.
Look, I could refer to the Sortino ratio, but
No.
I mean, we'd have to get a PhD to explain how to calculate it. So it doesn't really matter which way you look at it. Look, I think somebody, when you do something like the vol adjusting, number one, you have friction, you have spreads, commissions, time, and effort. Right. So the first thing is you've got to prove that it's even worth covering your spreads and transaction costs. But then you've really got to say, well, what is it adding to this? What is it adding to this portfolio? Right. And that's really the question. Is it actually worth doing any of this vol adjusting stuff? And obviously we would argue it's not.
I just wrote a piece about this the other day, Adam, where I was talking about industry's teaching us to do all the wrong things at the wrong time. This equivalence between volatility and risk. This is what industry says. When things are smooth and calm, or perceived smooth and calm, variance at risk, therefore, encourages to increase position size. Our Sharpe ratios increase, encouraging us to take more risk, institutions to take more risk into us. Our correlations, that they naturally increase as well. But all of this is increasing risk in a context that this smoothness is a guise. This smoothness is compression. This isn't equilibrium. This is when, markets breathe and they contract. This contraction is compression. This is a springboard before the risk event. And the volatility is not the risk event. That's the release of risk. That's the explosion that occurs from this compressed state. Now, the way industry has taught us is that they're equating smoothness to calmness. They're equating smoothness to taking bigger positions, volatility targeting, dynamic position sizing. All of these things are encouraging the wrong behavior at the wrong time. In these periods of compression, we should be fortifying ourselves. We should be aware that there is an explosion about to occur, long or short. We saw this during the period 2010 through to 2018, this great suppression of trend that occurred through central bank quantitative easing, this coordinated central banks across the world were suppressing trend. That created this apparent smoothness, this calm. Therefore, it encouraged people to buy the dip. It encouraged people to do all the wrong things, increase position sizing, take more risk because it's appeared to be safer. But then when we get the explosion out of that in 2020, when we got the quantitative easing flipping to quantitative tightening, we got a total flip and an explosion out of that compressed state where trends did amazingly well. That's a reason for this explosion of trends from 2020 right up to today. It's this release from this compressed state.
Yeah,
So,
in the end, they can't get rid of the risk.
No,
they can suppress it, they can squash it, but eventually that energy has to be released.
And guess where it's released? In the tails. So they compress it in the bulk and it migrates out to those tails. So it's a tail event waiting to happen or a pressure cooker waiting to release. That's where the risk lies now, in the tail event. It's the same as this continual increase in the S&P 500. There's risk building up underneath this supposed benign environment of this continual sort of growth. Everyone's right, if they're in the S&P 500, they can never go wrong. This is the same feeling that was received in sort of after the 1987 crash, from 1987 up to close to 2000. You couldn't go wrong being long the market. Everyone thinks, oh, this is safe. This is the way the market actually is. But you wait, when that compression explodes, this is the risk event. It's because systems that have survived during that regime, they're not capable of surviving the explosion or the movement that occurs from the market, which is a very natural thing. We know this occurs. Markets breathe and contract. It's just the designer of the system who's at fault here. We don't blame the weather for the falling down bridge. We blame the engineer for building that bridge too brittly. In the same way, rather than putting the emphasis of blame to the market being volatile or whatever, really the emphasis of blame needs to come to the system designer who hasn't got a robust system that can adapt to that situation that we know is going to occur time and time again.
And I think that you bring up a really good point, and you did it in a recent podcast too. And it's like engineering. It's building and engineering a building or a system or a bridge, and it's supposed to withstand the 100-year flood or whatever. Not, well, it's been withstanding it for many years now. I think we're okay. No, you have to withstand that the worst case possibility, which you may not even see in your lifetime, and you may stop trading under this false illusion that you had built something, you had engineered a system that could stand the test of time. And I think that's the issue, is that people get this false impression because they haven't seen anything happen. Well, everything's created equal. And, some things are better. There's better designs than others. I think that's what we're trying to say. By letting the profits run and not reducing open trades based upon correlation volatility is part of a system we built that in our mind and our purpose and design strategy, it's very conservative compared to dynamic position sizing. And I think that's the irony here, is that it looks like it's crazy. You're letting gold do what it's doing, and you're not taking some of that off due to correlation or increased correlation and volatility. And we're saying no, because we built the system to withstand anything that happens on the open trade equity side, because we're really put a lot of emphasis on this closed trade equity that we have and preserving the capital. And so we look a lot more risky. At the same time, we think we've designed these systems with the utmost care to stay in the game as long as is humanly possible.
Yeah, so I recommend people go to classictrendindex.com and have a look at the philosophy that underlies trend following, look at the managers that make up the index, and then just look at some of those statistics and think about why would you not want this style of trading or investing in your portfolio. And then, as you were describing the anti-fragile nature of the strategy, Jerry, I just kept thinking, it's like the kryptonite to LTCM. It's like the exact opposite. They'd be looking at it like, oh, wow, that's a huge rally, and it's completely disconnected from some pair, and we should short that, and then we should buy something else that's low, that statistically has been correlated. And we all know how that ended up for those guys. And I think they had some Nobel, economics prize winners on the team, and they were all very sophisticated. And I think it had a Sharpe ratio of 4, and then it went broke in 2 months. And who cleaned up? Yeah, right. It would have been the trend followers that were pushing those markets to levels that, not necessarily pushing them, but just participating in markets that were going to levels that were previously, unbelievable or inconceivable. So I know where I'd rather be: the small position sizes, the breakouts, and maximum diversification.
So let's now switch gears, and it's time for MythBusters. So Jerry, what are we tackling today?
Someone asked us this question. It was an audience question months ago. We never got to it, and I wanted to bring it back. I forgot who the person was, but and that is, and there's, I guess I owe it to our followers and to people who dislike us a little bit to correct, yeah, I know, to correct misstatements about what happened in the turtle program. Could be fun just to, I don't want to sit here like when people say things that are not true about the turtle program and just sit here quiet. I might as well just say, hey, did the turtles pyramid their trades? The answer is no, 100% no. Stop. Uh-huh. There was no pyramiding. Well, then why do some turtles say there was pyramiding? So I guess it gets back to, what is pyramiding? Let's define pyramiding. Now, I'll say what pyramiding is not, and this is what the turtles did. Let's say we had two systems, system 1, system 2, and they were breakout, and let's say 50-day high and 75-day high. Well, those two breakouts, any two breakouts can occur on the same day, at the same time, at the same price. So we were sort of told, hey, if system 1 and system 2 entry happens at the same price, why don't you space it out by like a half an ATR or 1 ATR, just for the heck of it, just for like some micro money management, risk management thing. Instead of buying the whole thing, wait a half an ATR or one ATR. So that's what we did. I don't classify that as pyramiding, and I'll define pyramiding in a second. I just will say that when you test that on a computer, it makes less money. Yeah, it makes less money. And I don't even have to test it. I know why it makes less money. I've done things like this before, probably not that, but we have designed systems that do space every time. We make sure they space. We force the spacing, but they didn't have that flaw of making less money than just following the system. Because basically, if you just do it that way, you're not following the system each and every time. The system 1 and system 2 said buy on the same day at the same price. So you're overriding the system. You'll never find a situation where overriding the system in that sort of random way makes more money than just following the system. Now, you may say, then why do it? Well, we did it because it underperformed slightly, let's say. But this sort of money management and risk management of spacing them a little bit. So hopefully, well, not hopefully, but sometimes you wouldn't even do system 2 because they didn't go another half ATR, another 1 ATR. So you saved yourself a losing trade. And so that sort of risk control is something maybe you're willing to do in order to, even though you have to sacrifice a little bit of profit. Because in my mind, what pyramiding is doing the next trade because you have this open profit. So I'll buy the first time at the 50-day, but as soon as I have a profit, I will buy more. If I have another profit, I'll buy more. So it's like an undefined maximum amount that you're going to put on in a trade. Whereas the turtles, of course, had their equations and their strategy where they knew exactly the maximum amount that they would put on any trade. And so I think changing that amount based upon an open trade profit is what I'm against. Because as we know, the open trade profit can kind of all of a sudden go away. Now I can't afford that trade. I could only afford it because I had a 1 ATR profit. Now I can no longer afford it. So the right way to do it, I believe, wait a second. No, there's no such thing as a right and a wrong way. The better way, the better way to do it is to not have a situation where you're saying to yourself, I can afford to do this trade because of this open trade equity. That's what I'm against. And that is too risky to build up these big positions based upon needing that and having that open trade profit be necessary to sort of afford that next trade. What do you think? Does that make sense?
It does make sense. Look, the way I was taught pyramiding back in the day was, let's say I had a 100 period Donchian breakout. When that signal was activated, when price went through that 100 period breakout, I'd buy a position. Then what I do is that I have one position alive per system at all times. I never add to that same system. But under the pyramiding methodology, when you then reached a profitable position in that and the signal was still valid, you'd take another position and then you'd progress until the trend ended. Now, what this therefore does is, for a single system, it's increasing position size. It's sort of almost like saying, we have validation in the trend strength, so we can add an extra position to it. That's not the way I see trends working. And when the reversal occurs, you inevitably have a very heavy position. And with these fast reversals, you get absolutely slugged. I therefore much prefer that's what I call vertical pyramiding, but the approach I adopt with, how I use these ensemble systems. Each system is individually configured on its own merit, and each system will only ever carry one trade at a time. It's only when that trade is exited will I allow for another signal in that system to be generated. So if I have 10 ensemble systems, each are behaviorally different, that is what I call horizontal rather than vertical pyramiding. And the difference there is that I'm not concentrating into a single trajectory. I am increasing robustness through diversity, but as these outliers, which can take all of these different forms, develop over the course of time, the ensemble has a much greater chance of extracting opportunity from that outlier because they're very unpredictable. A single system might capture a component of it, and if you invest too heavily in that system, you might miss a lot of that. And that's why I prefer this horizontal approach. And I think, Jerry, that's what you do with your multiple systems as well. Each are treated as individual systems in their own right. They're not compounding into a single system's position size effectively.
That's right. And I do know very successful traders who would plan to buy every the breakout and then 20 ATRs into the future. So they would do really well in Cocoa. Like they kept adding, but it's planned up front. It's not based on anything other than what they plan. So they may have the same risk exposure that I did, and I did all of my trades at the breakout, and they're just doing one of 20 different systems at the breakout and then adding one ATR after one ATR profit 19 more times. And that is their 20 systems. And they approach it where they know, if anything goes, it has to go 20 ATRs for me to have a full position. Now, I think there's other issues and problems with that, but I think that's a perfectly fine way of approaching it. It's strictly just we don't want a pyramid in the sense that taking on more risk using AUM that can go away very quickly. A 1 ATR profit can be gone in an hour or less. I mean, come on. Then what are you going to do? You get out because you no longer have the profit necessary. So, and you're hearing this from people who use closed trade equity, and of course, we would never do anything like pyramiding.
No, we don't do pyramiding because if you were pyramiding into gold all the way up to 4,400, would you then have to be de-pyramiding on the way down? You've got to do something with all those contracts on the way down. So, like, do you sell them all in one go, or like when the broker rings you up and says that's it, or do you have some system to let go of contracts in the reverse?
You possibly have your stop loss, so.
Like, do you have one stop loss? Do you have one stop loss for the pyramided position, or do you have multiple?
You use the same trailing stop because you're using the same system, using the same trailing stop. So all positions at the end of that pyramid, when the house of cards falls down, they all get out together. That's causing a big correlated whammy.
Hey, these are sophisticated financial markets. I will not have you refer to them as a house of cards, Richard. But what I do know is that AmiBroker can backtest pyramiding. I do know that you can set that up and you can backtest that, and but I never really found an optimal solution for pyramiding because I think the consensus here on this podcast would be is that we like the levels we trade at. We don't want to add to risk just because our account went up by an amount that allows us to buy more contracts.
Exactly. The same principle of dynamic position sizing, volatility. That is really doing that. It's increasing your exposure when you are certain that the trend is in force. Now, we're never certain.
You could get lucky though.
Humble.
If you were pyramiding and you did it over cocoa or gold, you could have got very, very lucky and you could have made a lot of money. And so maybe that's where this myth comes from. Maybe it comes from like this one guy that, pyramided into something that went.
We know the mighty of all mighty Mulvaney's does pyramid, and he got a spectacular result with cocoa. But what it also introduces is extreme volatility, which we also know is present in this program. This concentrated position creates this extreme volatility. And I remember last month when we were talking about ergodicity, and I showed you an example of how if you have a very large position sizes in a path-dependent regime, that really compromises compounding. It creates this volatility drag, this high volatility. And when you do what we do is reduce bets to as small as possible. That's why we're not adding to positions. We're keeping everything as small as possible, invested in a single system, a single market, etc. We're not pressing the point that we are certain of anything. We're just keeping this balanced risk across the entire portfolio. That creates a path where you can have very low expectancy but very positive geometric returns. And I think those that practice pyramiding, it might be very successful. You might get these magnificent results, but it probably will be accommodated with very high volatility, which I don't
Yeah, I was just thinking there could be another way to do it that might be safer. So let's say you got a breakout and you were thinking you might want a pyramid. Instead of pyramiding, maybe buy some futures and then also buy a strip of long-dated, out-of-the-money call options or put options if you'd sold the futures contract. And that way, your risk is defined by the cost of the option premium, and then you've given yourself enough time for that trade to work out, and then you don't really suffer a margin call because you just bought call options. So if the market goes berserk, like gold or something, and you'd bought some $3,500 calls or 33s or 3,300s or 3,700s or whatever it was when it broke out, you might still be in the money on those, and you probably wouldn't have paid that much. But once again, that's not what we do. It's just an idea. Certainly not financial advice.
People in the Dave Dredge world, people in the Wayne Hamilton world, they'll be nodding their heads on that one. People in the fast responders with the market turns, they'll be into that sort of thing. It's not what we do, but yeah, I can certainly appreciate where they're coming from.
Have we busted it? Have we busted the myth?
Yeah, I just wanted to clarify that my point is that you can have two traders who are put the same trades on in a market. They have the exact same trades on in cocoa or gold. One could be pyramiding, the other might not be pyramiding. And that is, it's just, it all revolves around this one idea. Did you determine how much your ultimate position could be based upon your AUM when you first put the first piece on? Or did you keep adding only due to this open trade profit in this particular stock or market? This is pyramiding, which is really a money management thing. It sounds like it's the same thing. Spacing is not the same thing as pyramiding. Spacing out your predetermined number of contracts is not the same as determining the number of contracts on the fly as you get this profit.
I think pyramiding sounds like a bit of a get-rich-quick scheme. Kind of like Martingale theory. You can't lose, It just doesn't seem
maybe Mulvaney
right.
is spacing. Maybe he's spacing. I don't know.
I don't know what Mulvaney does.
Yeah, he keeps buying into the trend. I'm not sure.
Oh, I mean, one way I saw to do it was to do it in a pyramid, like 3, 2, 1. So you start with 3 units, then you might pyramid another 2 units, and then finally you would pyramid 1 unit. Or an inverse pyramid. You could start with 1, and then add 2, and then maybe add 3.
Yeah.
We're talking about Aztec pyramids or Egyptian pyramids?
Do not try this at home.
All right, gents. Well, I think the MythBusters segment is over. Thanks very much for that, Jerry. But now, Jerry, we're going to turn the tables on you and get you to be the interviewer. So now we're moving into that segment called Spotlight. Where we are going to be showcasing our new book, which I'm just putting up here on the screen, our new book, The Aussie Turtles Trend Following Guide. And this is the loved work of Adam and myself, with a beautiful foreword written by Jerry himself, which showcases the mindset required before you become a trend follower. It's getting your mind aligned before you become a trend follower. But Jerry, over to you.
Well, yeah, I'm really excited, and I've read the book. It's pretty amazing. I want an autographed copy, though. What would it take to get an autographed copy?
It's coming your way.
Yeah. Okay. Then if I had to open up well, I think for anybody listening, opening up making $1 million investment into the fund, I think that would qualify. Probably Adam would sign his book for a big, huge chunk of assets. But when did you guys think about doing this book, and what motivated you to go forward with I'm sure it took you a while to write the book.
It was sort of a plan that Adam and I had, where we were talking about where do we take Aussie Turtles, and
could it have been hatched on page 183?
Oh well, yes.
Over a glass of Chardonnay.
Yes, it could have been
at Scotland Island.
And so the thoughts were this. Aussie Turtles, as you know, is a website developed for the aspiring trend follower. It's done in a fun way to bring people on board into the trend following way. And Adam and I were thinking, well, the first step is let's get the experience that has been taught to us by the likes of you, Jerry, the turtle trading story, and the experience that we've developed in the markets ourselves. Let's get this down on paper and actually give, in a sequence of books. This is our first book. This is basically getting the mindset right. But you've got to get the mindset right before you write the first bit of code, before you do anything. You've got to get that mindset right, which means a lot of unlearning of what you might have learnt in traditional finance. And, we see that through the need to unlearn that volatility is not risk, for instance. All of these things which are embedded into the mindset of the trader, you need to extract that from your head. So the first thing you need to do is get your mindset right and also your psychology right. So this first book is doing that. That's the attempt. So Adam said to me, we've got to get this down first with the mindset and the principles and the philosophy before we can move on to giving people a guide. And so our next book, which will be delivered next year, will actually be in the nuts and bolts of putting an outlier hunting portfolio together. And these two books, getting the mindset right and then the practical guide, will form the backbone of future training that Adam and I plan to do with Aussie Turtles as we go to visit you in New York, go to visit people in South America, go to visit people in Europe. That will be the training program face-to-face with people, but as an accompaniment to that training program, these books will be the essential reading and the guides that they can refer to. That was the intent, Jerry. And Adam, of course, you know how I'm verbose. My wife says that I'm verbose. Everything I do is verbose. Adam sat behind me with a large whip, reducing the verbosity to something that's fun, something that can be absorbed quickly by people who might not necessarily have the academic qualifications or the degree in quant science to understand these principles. So we developed this book to give them the right mindset and the framework that's easily absorbed, that's not verbose, is short, it's packed. That was the intent.
It's sort of it's condensed, but it's very easy to read. In my opinion, you could knock this over in in a weekend or in a couple of sessions if you wanted to. But then I sort of keep finding myself coming back to little nuggets that I think Rich, we've embedded throughout this book, and it's just got so much framing for how to approach trend following. Sort of perhaps for the layperson, I think it would be an excellent place to start. But then also for experienced traders, you might be going through a bit of a tough time in a drawdown, or you might actually probably when you should read this is when you're euphoric and you're at an all-time equity high, and it might temper your desire to maybe double position sizes or something crazy, something crazy like that. But we can go into some of the sections a bit later. But I think it's really just about connecting with our audience in Australia and globally, and trying to share this concept of convexity, because I think that's what runs through the entire book, is how to get exposure to convexity in financial markets.
Yeah, I think you're really smart to start with the mindset. That's exactly the way the turtle class, the 2-week turtle class, was started with. Let's get these people, understanding the mindset that you need and unlearning certain things. And that's always, it's always important. We came in with a little bit of baggage, not too much, but a little bit.
When you went into that program, Jerry, sorry, it's an aside, sort of not related to the book, but when you went into that program, how much trading experience had you had? Like, what was there to unlearn?
Well, there wasn't much trading experience. I had a little bit of trading experience, trading some stock indexes, just kind of on my own. And I had read a lot about trend following, but I hadn't really used trend following, and I had no idea about sizing positions and things like that. I think the one thing that I learned more than anything was how hard it is to be disciplined, and how hard it is to not be influenced by losses and profits as well. That's the first, we came out of the class, and the most important thing was do the trades. Just do the trades. Not how to do them, but you still have to do them. And I think in the first week, I probably did a third of the ones I should have done. And how do you do that? I mean, what was I thinking? Why was I thinking that way? I think some people start slow, and it just takes experience, and you just have to make some mistakes along the way. So hopefully the book will help people make fewer mistakes. But I do think I've never seen a book like this, so I think it really is going to meet a need. It's not similar to other books. You're starting at ground zero, the basics, and not getting into what everybody wants to sort of think that they should get into first, which is entries and exits, and what's the right parameters and things like that.
Yeah, it's often best to really slow down that quest to get it started and concentrate on rewiring that mindset. So with when you're accepted into the Turtle program, with the assessment process or the recruitment process, were they looking at someone who was already predisposed to or rewired to trend following? Was that part of their selection process, or those people that hadn't had experience, hadn't had the traditional dogma embedded within themselves? Is that what happened?
I think both. I think they sent out a 100 true-false test that you were supposed to take it and send it back in before the interview was granted. So you send your resume in, you get the true-false test. And the true-false test, a lot of the questions revolved around trend following, and something that would have a trend following like type of an answer to it. And so they wanted people. So some people did very well on the test, and so they wanted to hire some of those people who knew about trend following, and and also part of the test that I'm sure I aced this part, and that is, are you the type of person who will always follow the rules? And I'm sure I aced that. Yes, of course. And so that's the problem. You can ask and you can put a test together, but until you know this person, they get in there and they are faced with looking at the markets and the charts and deciding, okay, we have a trend here, we have a trade here. Is this person going to pull the trigger? That you don't know. No one knows. But some of the better traders were those who were just who had never heard of trend following. They were really good and were willing to follow the rules.
Well, hopefully we'll start with this book, and the way we've done it is pretty similar to your program. It's rewiring, introducing people to rewiring, getting them into the right mindset. And when I was writing this with Adam, my thoughts were, I don't want this just to be another book that sits on the shelf, a big thick book, really academic, really thick, because it's hard to read it the first time. This has got to be a book that people return to. It's done in a fun way. It's done in a way that I think is memorable. It's fun. People will return to it. It'll be that sort of guide that sits there. You can take with you on the train. You can go to the beach. Bit of a giggle.
It should be creased. You need to crease this book.
Yeah,
and actually, some of the best bits are in the appendices. I mean, they're just amazing. They're absolutely amazing. And I was rereading it this morning. Appendix B, 10 immutable rules for classic trend followers. I mean, I'm not going to give you all 10 on this podcast. You're going to have to buy the book. But
exactly.
Number one, cut losses immediately. What an excellent place to start. Let profits run. Follow the system every signal. I mean, I don't want to read all of these out, but if you actually read this and digest it and follow it, I think you're stacking the odds in your favor. And so I don't know what, everyone's got a different bet size, right? So, Jerry's, your bet size is, pretty substantial, I would say, at this phase of your career. And we have a bet size, and it's a certain amount of dollars at the moment, which represents, a fraction of the portfolio or equity, however one chooses to define it. And I'm just wondering, if people actually took that standard bet size and maybe some multiple of it, and then applied it to resources like this book before they started trading, I think your chance of success would be so much higher or improved than just jumping in and starting to take trades, without really understanding what you're doing. So
it has gone through the backtest environment. We sent it to Jerry to read for him to write his forward. So it passed the backtest, I think. Jerry, any concerns? Any areas you thought, no, change this?
Oh, no, of course not. I've learned so much from you guys before the book, so I was really excited to get my hands on it. So my final question is, I heard about outliers when I was in the Turtle program. I heard what an outlier was. I probably had never heard that term before. But how did you come up with outlier hunting? And why is that specific term so important? Because you coined that, Rich, I believe, the hunting of the outlier. Not, I never heard of that phrase before. It's more like we're going to have outliers and we have to take all the trades. But I think you felt the need to say it just the way you say it, which is, no, I'm an outlier hunter. What does that mean to you?
Well, it means to me there are lots of different forms of hunters, Jerry, and I think the type of hunter we are is a spider with the spider web. In other words, we're not out there running down our prey. We're not there with precise sort of like the cheetah, precise directions running down their prey. What we're doing is we understand the mechanics of the market. We understand it's non-Gaussian. We understand it breathes, it contracts, it expands. And we say to ourselves, right, well, in that context, how can I be the best hunter? And the best hunter is not through prediction, because every time you predict, you change the system you're in. It's reflexive. But the best thing we can do is set traps. And we set traps through pre-planning, applying a rules-based process. It's by saying, all right, let's extract our emotions out of this market, because those emotions are coming from a brain that hasn't evolved in these markets. Let's use our computers as our brains and let those computers tell us the rules to apply. And we say, right, no matter what our minds are thinking, they are the rules to apply. And that actually sets the spider's web, the trap. It's diversification, wide diversification across all liquid markets. It's small bet sizes. It's building the web to be resilient, robust. It's not about prediction at all, because we know that we are going to catch our prey in that web, and we're going to be able to devour things that are many times our own size, the outliers. We might catch birds in there. We might catch things we never anticipated, simply because we've built robustness, diversification, a web. And this is coming from a rules-based process, the rule of the web, the creation of it, setting it in place. It's the preventative risk treatment. It's not the reacting to risk when you're in the middle of it or in the middle of a typhoon. This is setting this web in place long before the risk event happens, so that we can capitalize on this risk, this volatility explosion. We can turn risk into opportunity, and we've got robustness and we've got survivability. We can survive because we're not directly confronting our prey with a head-on attack. We've got a web that tires them out. We just sit back and watch it, and then we come in and we go and eat them once they're all sort of. That's what we do. It's the way someone sits. The ape man in the savannah sits on the branch of his tree. He sees all of these other hunters doing their things. Some are successful, some are not. And he's thinking, how can I outwit and outlast these people? It's a bit like the game of Survivor. And he sees this spider in the distance creating this web. The first time he sees it, he doesn't pay much attention to it. But then when he sees what it's doing, it starts capturing his mind and starts saying, well, under uncertainty, this is how this spider is capturing. This is how he's the best hunter of all. That's what I think this is about.
Yeah, well, Appendix D trades that move the needle. It's got, some classics, and my goodness, we made so much money in these trades. Cocoa, 2023 to 2024. I mean, I'm going to remember that forever.
Oh yeah,
that was just an amazing trade. You've got crude oil going,
especially since cocoa had never really done much before then. That's really one of the fun things about why it's so important to not remove markets. Not that you pay attention. Like when I put together my portfolio, I never looked to see how any of the markets have done historically. I could care less.
Yeah, that was a good one, and not good if you didn't have cocoa in your portfolio, because it was a poorly, quote unquote, poorly trading market. What a mistake! You read this book and you'd understand why you'd have to have cocoa in the portfolio. Yes. And then you've got the gold breakout. You're going to have to update the book for the most recent gold trade, because I think that might even surpass the 2009 to 2011 gold bull. But I mean, such good examples of these big winning trades, and then also juxtaposing that with, to actually be successful in trend following. This book talks about how do you manage the 60-70% of trades that don't go anywhere, because obviously it's easy to make money on the winners, right? They're going to take care of themselves, but it's how do you deal with the mundane and perhaps frustrating, certainly frustrating 60-70% of trades that don't go anywhere or give you a small profit or a loss.
Yeah. Well, listeners, if you're interested in getting your hands on this book, it's available right now on Amazon. So just go to your Amazon website, type in there Aussie Turtles, and you'll be able to see our book, the Aussie Turtles Trend Following Guide. Alternatively, if you go to the Aussie Turtles website, there's a direct link in there which links you to the Amazon store. It's available in Kindle, paperback, and hardcover. We have yet to do an Audible version. Maybe we get Jerry to do the Audible version of the... But we hope you enjoy it. We're pretty proud of it. It's a good start of many more to come. And if you do pick it up, we'd really appreciate it if you could leave a review on Amazon. It really helps more traders discover the book and join the movement we're trying to start up. Well, that's it for the Spotlight segment. Now it's time to move on to Shell Mail. And we've had some excellent questions this month, so let's dive in. So the first question is from Asim Khan on Ensemble Systems. And Asim says, why does adding more systems to Ensemble flatten his return on investment but doesn't always improve his drawdowns? Now, I'll respond first and then you guys respond, but it's a good question, but what I feel Asim is observing is actually quite common and expected when the ensembles that are being built are from similar trend-following systems. So if the systems are all designed around the same core logic, for example, all breakout models with similar entry and exit rules, or trend models that use similar parameters or indicators, then the ensemble's internal correlation remains quite high. And in those cases, diversification benefits are less limited. And when you reduce the position size of each system to maintain constant portfolio risk, you effectively dilute the return without meaningfully reducing drawdown. So for Asim, the key to an effective ensemble lies not in the number of systems, but in their independence of design logic. True diversification comes from combining systems that respond differently to structure in the data. For example, different look-back horizons, volatility filters, breakout definitions, trailing mechanisms. When systems are designed to express different sensitivities to trend persistence, volatility and mean reversion, noise, and their collective behavior smooths the equity curve without sacrificing that fat-tailed return profile. So yes, what Asim is seeing is generally expected when systems are too similar or scaled mechanically. But the goal is not just to add systems, but to add what I call orthogonal edges that capture different manifestations of those trends. Guys, do you have anything to say in addition from Asim's question?
I can't improve on that answer, Rich. It was excellent.
Oh, do we have to improve on it? Or
No,
can we
well,
just like...
you could debunk my
No,
explanation, Jerry.
I can't debunk and I can't debunk and I can't improve, but I still want to say something. Yeah, I think it's difficult to... Now, we don't really know the details of his back test and how he has run several back tests with multiple systems. We don't know the details. So if we knew the details, we could maybe say, oh, I see what you did wrong, which I don't know if you did anything wrong, or I could see why you came to your conclusion. But I would just say that it's very difficult, in my experience, it's very difficult to stay with all trend following systems and stay in a good place of shortest term parameters to longest term parameters, and to stay in that juicy area where the systems are, you're not trading a trend following system that is too much worse than the other ones, and pick up a lot of diversification. So I sympathize, and I am not skeptical of his results. However, I think what you can get, I can give you a really good example of what you should get from even systems that are trend following, all trend following, and that really only have, and they're very similar in parameter sets. And that is, you will, I think the best you could hope for, maybe most likely thing you can hope for, is going to be that on any individual trade, a big outlier like gold, for instance, you will not get out of gold, get out of your entire position at the same spot. And that will probably help you to have more consistent and smoothed out annual returns. So if you're out of gold now and gold crashes and the rest of your systems get out later, then that's going to help. If you're out of gold now and it goes back to new highs and keeps going, and you've got to put the trade back on and resize at a higher ATR, bummer for you, but you're going to make less money than if you would have done something different. But at least you don't not get into these situations where it's all or nothing, and getting out of this gold trade, because no one knows if this is the end of gold or if we're halfway there. So having multiple exits, although the drawdown may not be materially different, I think the profit and loss might be quite a bit different, and it may help smooth out and add some consistency to longer term returns. What do you think?
No, that makes sense, Jerry. In a way as well, it comes to this principle of loose pants. If we imagine that cocoa trade, one system could have been nailed through that reversal of cocoa trade, even with loose pants, but an ensemble of systems, etc. What you're doing is you're maximising your opportunities to stay in the trend. Each system defines differently what they think a trend is. That's how these systems are configured. There's no central agreement on what the trend is. They're all trying to anticipate trend in a different way and define it in a different way. And an ensemble, when you've got many things attacking something, it's better than one thing attacking something. And it's a bit pyramiding, where we said we don't sort of increase our positions into a single trajectory. We are creating diversity of possibility there, more robustness, less correlation.
So a month into the gold trade, or a few weeks into the gold trade, how much what level of correlation would you be happy with your different systems? 100%. It's only 100%. I want to be 100% long gold. I don't want any diversification. Now, when I got to get out of this gold and it starts selling off, okay, I'll take some diversification. I don't want to get out. I don't want to roll the dice and say all or nothing. I'm out of gold, or I'm staying in all or nothing. I've got one exit. Now, you don't want to have that sort of mentality. It plays with your mind. It plays with you being consistent and being disciplined. So if you have multiple exits, it's really important for psychological reasons as well, in helping you to stick with it and understand that it's not an all or nothing decision that you're making here. Because if you're trading 20 markets, or 50 markets, gold is a big deal. I trade 400. Gold is not a big deal. So I can relax, but I'm still trading it with multiple exits, multiple systems with multiple exits.
On to our next question from Ben Scott, who's talking about no trade after a win rule. So Ben asks about the old turtle rule, no trade after a win. This was one of those filters designed to prevent clustering in the early turtle systems, according to Ben. So, Jerry, over to you. What do you think about that? No trade after a win. Do you use it today? And what were your thoughts? And was that applied in the turtle days?
So we called it last trade a loser. So you needed the last trade to be a losing trade in order to satisfy, when you have the breakout, you also needed the last trade to be a loser. And so we used it, but we also used things like consolidation and false breakouts, last trade a loser. So you basically wanted a lot of no recent profit in the trade. You don't want to get short after a V top or get long after a V bottom. Now we've seen these V tops and V bottoms recently, and sometimes they're really good places to get short and long. But if you look at a lot of data, the more consolidation, the more losing trades, the lower the volatility possibly. And I'm in favor of all these things. I don't know I can't swear to last trade a loser if it ever worked. When we tested it after I left Richard Dennis, we could not get it to add value. Obviously, it probably did work at some point. I think the key here to any sort of filter like this is a good filter can never stop you from it can never allow you to miss a big trend. So maybe you have a breakout at the 50-day high and you're looking at consolidation, low volatility, false breakouts, and last trade a loser, but you don't have enough, you don't have any, or whatever. So maybe you say to yourself, okay, I'm not going to take the trade at the 50-day breakout, but I'm going to wait to the 100-day breakout if it doesn't have those sort of things. So you need to have this fail-safe method that says, I've got these filters. Some of them are not what Jerry thinks are good filters because they will allow me to miss a trade. So I'm going to have this 100-day breakout or 150-day breakout where I say, okay, all bets are off. Nice try, but I'm going to get in this trade because I'm not going to put myself in a situation where I'm going to miss a trend. And a good example is maybe at some point in time, last trade a loser worked. I don't know if it works now. We never got it to work, so maybe it changed. So you don't want to look back and say, oh yeah, I did miss a big cocoa trade because the last trade wasn't a loser, but now I don't use that anymore because it doesn't work. So you don't want to have these regrets, and you want to be a trend follower every day, every minute of the day, and find the breakouts without these filters is probably okay. But if you're going to use filters, you got to be careful.
Yeah. Adam, anything to add to that, or happy with that?
I agree with Jerry that at some point you've just got to be in those trades because not every trend is going to behave very nicely for you. It's going to signal a breakout, and so it's going to flash up on your screen, and then it's going to pull back so that you can buy it at a really, really nice price. That's just not how the market works.
Yeah.
In fact, it's more likely to gap through your stop and then just keep going. And then you've got to, do I buy it now? And then you wait an hour and then it's higher. And then you wait a day and it's going to be even higher.
Yeah.
And then you look back.
Goodbye.
Yeah, still waiting for the retracement.
Oh, yeah.
And in the meantime, it turns out being the best trade of the year and you didn't have it.
These are loser ideas. These are horrible ideas to the ones you just rifled off. They're horrible. I know Rich used to say, the best trades, you're going to get the worst fills. You're going to have to chase it. If you want to put a limit order in, it could take you all day or 2 days. So throw it in at the market. You can't let this thing get away from you. And one of the worst ideas, I read this on Twitter sometimes from traders, wannabe traders or whatever, and it is, here is a good setup. I'm going to wait for a good setup. I'm like, setup is one of the worst ideas ever. I wouldn't pay any attention to a setup. I would. And what is contrarian? What does no one want to do? I can tell you, they want to brag about how much slippage they got. Why are you bragging about your slippage? Because I think it may signal I'm onto a really good trade, and I have a long-term perspective, and I want to hold on to this trend for hopefully a year and make 100 ATRs. And so the last thing on my mind is going to be whining and crying about the amount of slippage I got or how much I had to chase this thing, which no one says. So because no one says it, it's probably right. Embrace your slippage.
And yet
Love your slippage.
There'll be positive correlation between high slippage and explosive trends that get us way away from our stop loss. They're the ones we want. But
I think it's agreed. We're not doing the no trade after a win.
We ran this back test once of spacing. It was a spacing back test. Space things out by 1 ATR. And what happened is they wrote the code incorrectly. So what came back was this idea, what the code actually did was you couldn't buy on the breakout unless it was 1 ATR past the breakout. So you need to see this massive explosion past the breakout. And it added a lot to the trade. So we kind of stumbled onto this idea of more trend and more explosive trend and more slippage was actually better. We just stumbled onto it by accident.
Sort of reminds me of this backtest parameter that's kind of easy to do in these programs is, do you buy on the breakout level or do you buy on the close of the day? Or do you buy on the open of the next day or the close of the next day? And so that's like 4 really easy different entry prices that you can test. And then you can do the same thing with your exit. Do you exit on a hard stop or the close or the open of the next day? And you're going to find some patterns in there if you do that are probably going to guide you in a certain way. If you accept the data, some people just, oh no, I just can't accept the way that data goes because it doesn't fit with my mind of how markets should work. But, well, maybe markets don't work the way that you think they should work, right? And that's why you should be making sure that you have that trade on. You should have that trade on as soon as that level execute or triggers.
All right, next question. Slav Z, ATR versus price-based stops. So Slav asks about trailing stop construction. ATR multiples versus price-based levels like the 50-day low, which, Jerry, I think you deploy with some of your systems. So he says, hi, guys. First of all, I'd like to thank you for your excellent work you are continually doing. Thanks, Slav. I was wondering if you've ever looked or researched into trailing stop techniques, mainly the difference between ATR multiples versus price lowest low, say 10 times ATR, an ATR period 20 versus a 50-day low. Of course, the look back of parameters will vary. However, on a molecular basis, which one, if any, would be more beneficial to a trend follower? Thanks a ton, Slav. So, Jerry, you first and then Adam.
I would be in favor of using both and using a few other strategies as well. Moving averages, I guess, are okay. And there's probably lots of other things you can get, and just change the parameters around to make it more long-term would be my main suggestion. But I think I'm in favor of any kind of, and this is a great way to diversify probably. I haven't done the research on the ATR based, and I don't think either strategy better aligns with true trend capture, whatever that means. So, but yeah, I think even if one tests out a little bit better than the other, the diversification of the ensemble would probably be very beneficial.
The first thing I would say is the 50 days that your pants are too tight. That's not going to work. No, you're going to cut off some circulation or something with that 50-day thing. So you need to widen.
Yeah, 50 days is no good.
So, yeah, I think you need to widen that out and 10 times ATR 20. I even feel like the ATR 20 is too short in time. So I think it maybe will make everything too volatile because your stop. I know you should be if you're doing this properly. You should be basically you have what's called a non-volatile stop, and I'm using AMI broker programming talk there. So you have a non-volatile stop, which is how you define it in AMI broker. And I just think every day the ATR 20 is going to be changing so much. So day to day, your stop could be like going up and down before you put the trade on. Then obviously, if you do it with a non-volatile stop, that'll be fixed for the life of the trade. So I would consider maybe making the ATR a bit longer. But 10 times sounds like a nice round number. Maybe you want to make it longer as well. So I would say in general, probably your pants are too tight across all of those parameters. And you could probably get better results if you made them all higher numbers.
All right, last question from Sebastian Jung, handling an outlier. Sebastian, just sneak this one in for this podcast. He says, so Sebastian's from Germany, and he asks, when you had a big outlier trade, how do you integrate the money you have made into the next trade or trades? Do you take all the money you have made into the next trade, or do you take only a part from it and hold some of the money in cash for the next trades until all is used for new trades? For example, so Jerry,
this guy is opening a hornet's nest here with this
I'll
last question.
We're
going to end up in a big argument here, and then I've heard there's been some conflicting opinions on different podcasts. Why would we end on this?
Okay. I'm going to have a crack first to simmer the room, and then you guys jump in. So for me, it's simple. Once the trade is closed, the profit goes straight into our closed balance equity. That means the win is realised, but it doesn't mean we automatically size up on the next trade. I'm far more deliberate when increasing position size. So personally, I wait until my closed balance equity has doubled before I double my trade size. And this takes a lot of time to achieve, but it keeps position sizing independent of whatever regime the market happens to be in. So this is what I call weak compounding. If I've got an outlier and I've just got all of the proceeds from my outlier and it goes to my closed equity, I don't immediately size up. No, I'm waiting until my closed balance equity significantly scales up to support the increased position sizing. This is, to me, is a conservative path-dependent approach that gives me the best geometry. Too much volatility or too much changing of your position sizes introduces unnecessary volatility and the associated drag on your compounding of your wealth. So that's why I do it, because leverage is this two-edged sword. It's not always beneficial to you. It's a two-edged sword. So it compounds mistakes, but it also compounds your winners. And if you grow too quickly, an unfavorable geometric path creates this volatility drag. So that's how I view it. But Jerry and Adam, over you.
Let me go first, because then we can end with Jerry's wisdom. So what I'm going to say here is I think it depends, and it depends on what kind of trader you are. So I would say
a good one or a bad one.
No.
Bad one.
No. Well, yeah, if you're a bad trader, your position size should be 0. So that's, if you're a bad trader, I would just make it 0. But let's assume that you have some skills. I would say if you're managing your own money, then I would use a fixed bet size that represented a portion of your opening equity when you started trading. And I would probably keep that bet size in dollars the same, and then I would adjust it at some point in the future using some discretion. So I wouldn't resize based on open equity if I was trading my own capital. And so that should lead you to have pretty consistent contract and position sizes, hopefully, unless markets are really changing in volatility. And then I think that if you are running a fund or a pool of money where there are subscriptions and redemptions, and the amount of money that is being managed can change materially, then I think that having something that was linked to open equities is probably more appropriate.
Well, I think that's a really good point that I heard on a podcast recently, and then you bring up again. I think that's a really good point about allowing the open trade equity to fluctuate. And you're kind of assuming that, hey, look, we're all up X% in gold. We're all making money. And so we can all withstand, this idea of we're just letting these profits run. And as you say, some people come in at the peak of gold, and they come in at the peak of your equity. And so I think the way that I would prefer to handle that philosophically is do the right thing with your trading. Do what you think is the best. And if it is to, which I agree with Rich, have this closed trade equity, change it infrequently, changing it when it doubles. I'd probably change it quicker than that. But being very careful, overall, I would just say philosophically, be careful including open trade profit that can go away very quickly in sizing trades. Philosophically, that's what we're just trying to do. We're recognizing that if we look at our AUM today and size trades with today based upon that AUM, and then we lose a lot of the open trade equity in gold and silver and platinum and palladium, well, then what are we going to do? And so it's just risky to do that. So I would increase it, but I do like this whole idea. But the way I would try to help solve the problem of new investors is to tell the new investors, don't invest now, right? Look, I'm saying, like, you can invest, but we're up a lot on some of these trades, and we're not going to take a small loss for you, because they're not small losses. They're big winners. And so give us 25% of your ultimate investment per quarter. Leg into this versus, hey, I'm on purpose going to choose an inferior way of trading. And if you don't think that's the premise of the objection, I think, is that we're going to do it. We're using as an evidence that we should not use closed trade equity as because we have clients coming in and out. I don't think that passes the scientific test of a back test. Hey, I would like to follow the back test, but our clients won't like it. I mean, you got to do better than that. Maybe you got to walk that fine line sometimes, but it just seems to, in this situation, to be a little bit silly.
So it's time to wrap this one up. Jerry, any closing thoughts before we sign off?
No, I had a great time seeing you guys and getting back into it, and I wish we could do it more often. And congratulations on the book. I'm going to promote the book, and I can't wait to get the hard copy and get it signed next year, Las Vegas.
Perfect. Adam?
Next year, Las Vegas. That sounds like fun. What a month. I feel like I need a holiday after trading October. I think it's been up and down and all around. So hopefully we can just get through the next couple of days and print some nice numbers. Yeah, check out the book if you got a chance.
There's a song that should go for a trend follower this month, those magnificent men in their flying machines. That's what it's been like.
Absolutely wild.
All right, and before we go, just a quick reminder, if you haven't already, grab your copy of the Aussie Turtles Trend Following Guide on Amazon or at Aussie Turtles website. And if you enjoy it, please take a moment to leave a short review on Amazon. That's it for episode 8 of Turtle Talk. Thanks for joining us. We'll be back soon with more charts, ideas, and stories from the world of trend following and question 5 revisited. And until then, stay systematic and stay patient, and may the trend be with you.
Thanks for tuning into Turtle Talk. If you enjoyed the episode, don't forget to rate and review the podcast. It really helps us reach more listeners. Share it with your friends and invite them to join the conversation. Got a question for us? Send it to info@aussieturtles.com, and we'll do our best to feature it on a future episode. Please note, Turtle Talk is for informational and educational purposes only. The views expressed by the hosts and guests are their own, and do not necessarily reflect the opinions of the podcast producers or affiliates. This podcast does not provide financial, investment, or professional advice. Always consult with a qualified professional before making investment decisions. That's it for today, folks. See you next time, and as always, may the trend be with you.